see the clock, looks like it's about 3:23, Tuesday afternoon, January 21st? All right.
Hey, right time.
Yep. This is the meeting of the other post-employment benefits, or Opeb Trust. Call it to order. First item on the agenda will be, first item, as you all know, Lisa Trost moved on since our last meeting, so she was our secretary, and so we need to nominate a new secretary.
Mr. Chairman, I move to nominate Lisa Lynch as our new OPEB Trust Secretary.
Second.
Second. Any discussion? All in favor?
Aye.
Congratulations.
Thanks.
We only have people named Lisa in this position.
I know, it's easy for everybody to remember me, right? Remember my name anyway.
All right, second item would be the minutes of our meeting of January 29, 2019. Wow, so we didn't have a 6-month one.
I move to accept the minutes of that meeting.
Second?
All right, any discussion? All in favor?
Aye.
Aye. All right. So now we have the presentation by Bartholomew and Company.
Thank you, Mr. Chairman. My name is Brian Jimrose, and this is Kathleen Klawacki. I'm on the outside advisor team, and Kathleen is on the inside investment management team. We appreciate you guys offering us to come out and do our annual review. If you ever need us more, please let us know. We'd be happy to come out and work with you. In your package, I've given you a performance summary through December 31st, 2019, and then a couple of fact sheets for Pantheon and Partners Group, which I'll talk about in a minute. We were out here last time on the end of January 29th, 19. Markets have changed quite a bit since then. We'll have Kathleen talk about that briefly, where we've been in the last 2 years, and talk about some of the changes we made in OPEB since the inception of February 16, 2012. Just to remind the committee, just to bring everybody on board, since we have a new member, Lisa, thank you, congratulations.
Thank you.
It's also helpful to elect her before the meeting, so she can write all the minutes too.
Yeah,
So
thanks.
we appreciate that. The model when we first started out was in a more conservative portfolio with less equity starting on February of 2012. We changed that to a moderate portfolio in 2013. That was October of 2013. That stayed in that portfolio until about January of 2015, where we moved it to a moderate aggressive portfolio. One of our recommendations to the committee would be to move that up to a one notch more to an aggressive portfolio, which is just an additional 5% equity exposure, okay? We can talk about that in a little bit. These are long-term funds. These are distant cousins of pension funds, so we like to see those about a 70-30 split with the amount of money you have in and with the unfunded liability goal that we're trying to achieve. You guys are doing well. We'll talk about those results. This past year, we've added in some private equity. Private equity is nice to add into the portfolio for a couple of reasons. It targets a rate of return of 10 to 12% versus public equity of 8 to 10. So it helps your unfunded liability decrease, which I've given out those little one fact sheets, if you could take a look here. The one we just recently added in November of this year was Pantheon. Okay, we can talk about that a little bit. It's in your portfolio. That one just started in the portfolio as of a December 1st subscription date, okay? We'll talk about all that if we go along. Please stop me with any questions, please. But I'm going to turn it over to Kathleen to go over the portfolio review and how much of an economic update you guys want. We can go over as much or as little. We can go the short version, middle version, or the long version.
I'd like to hear a little bit what you think is coming up, because you're recommending to us to maybe increase how aggressive you want to be, but I also hear on the horizon that we may be heading towards a little recession.
Absolutely,
And
we
you've
can talk about
got
that.
presidential elections, that always disrupts the market, so maybe the timing isn't right.
Sure, and we're not necessarily saying today, but as these funds are long-term in nature, we want to get to that goal. That's what we're talking about, so certainly. So
Yeah.
I'll turn it over to Kathleen. She's on the internal team. Kathleen, if you can go over a market update, last couple of years, and
Yep.
then where we're at.
Yeah. So last time we were here, around this time last year, if you remember, we talked about how 2018 was a really good year in the markets, and then it ended pretty abruptly with the Christmas Eve really was the day that the market kind of took a turn and ended up negative for the year. So 2018 was volatile and a little bit more difficult. And then 2019 has been, to your point earlier, we were saying totally opposite. Really, really strong markets, over 30% return. And not only just the markets, but from an economic standpoint as well, the labor market has been really strong. Unemployment rates, if I'm sure you've seen, are really, really low. Job creation was very strong for all of 2019. That's come back. The most recent figures, we've seen that jobs are actually starting. They can't possibly create as many anymore. So it makes sense that job creation has come down a little bit. On the housing side, that I saw today, one of the strongest figures we've seen, people are still building houses and permits are coming up and things of that nature. So it really is a testament to mortgage rates being low, but also people feel like they can upgrade and buy more houses. So that's really important. And what the most important thing that we see, and when we're looking at all this data on our team, is the strength of the consumer. So that makes up most of GDP, and it's so important for the consumers to be strong in spending money. It's kind of obvious. But everything we've seen as far as the health of the consumer, it's still really strong. So we're positive on economic growth continuing, maybe not as perfectly, and it wasn't perfect, but for the most part, it was pretty perfect in 2019. We think it should continue, but maybe not as strong. Maybe, unemployment can't go too much lower, things like that.
So consumer confidence represents 2/3 of the GDP. So it's interesting, consumers are still spending out there.
Yeah, so, and like you said, with the elections coming up, we'll see, I think, a lot more volatility than we saw last year. I think that's normal. I think 2019 was one of those years that just wasn't really normal. It was great, but we think that probably can't continue. And we know whatever happens with China, whatever happens with Iran, whoever's elected, there can be some volatility implications to that. So that's kind of the high level for now, but I can jump into this if anything.
Just a
Comes
quick
up,
question
yeah.
on the stats for housing starts.
Yep.
Does that take into account all the rebuilding, from all the natural disasters we have?
Yes, I believe it does.
So it is a little misleading.
Yeah.
Some of it's just rebuilding what was there and burned
Yes.
down or
So that's true. But that's
swept away.
right. Yeah, and it was funny. I don't know the exact figures, but their expectations were really low, and it blew the past month, blew it out of the water. It was kind of it was so crazy, the number, that it made you think, how could that possibly be? And it is definitely partly to do with that. Yes, that's a good. So it is skewed for sure, but still fairly strong. Yeah.
One thing is wage growth. Unemployment's at 3.5. Participation rate is also at an all-time high, and so those two numbers together tell a more of a story than just unemployment rate being at 3.5%. You want to consider that. We definitely have some volatility in the markets coming up, as Kathleen pointed out. When we talk about an increase in your equity exposure, we're not saying necessarily do it today. A couple of things is, not that you can't, but we want to get it in over time. Another thing is, we would recommend, as you dollar cost average, you guys dollar cost averaging in the the deposit on an on a quarterly basis, Mr. Chairman?
No.
No?
We do our contribution that's in our budget, our fixed contribution, we do beginning of July.
July, okay. For
And
the-
then we do one in October, when we revote the budget, and know what our certified free cash is. We had a
Okay.
big lump sum this year, we had
300.
300 and, about 300,000, 315,000.
So one thing to consider if you're concerned about a volatile market is definitely doing a dollar cost averaging approach into 4 quarters, if you could. And that way, if the markets are down, and you do the dollar cost averaging approach, you'll get more shares per dollar. And it's a good way to enter those dollars that have no equity exposure to them as well. So 2-part. That would be a recommendation, especially at a larger dollar number with the contribution. We're not telling you what to do. If you're not comfortable doing it, don't do it, but that's our
The
recommendation.
current rate of return is moderate, so it's what, 4 to 6, or what's the expectation?
Yeah, so good question. So expectation so what we'd like to see you at is a 70-30 portfolio. Right now, you're at 65-35. We have alternatives in there as well, alternatives being part of the private equity. Alternatives help smooth out the ride, so you don't see the bottoms and you don't see the tops of the market. Expectation is 7.5 to 8%.
Yeah, because I thought it was 4 to 6 that last time we talked about it, going to moderate.
Well, we're at moderate aggressive now.
Are we at moderate aggressive?
Yes.
You are currently,
All right.
yes. I'm
And what
sorry.
is the expected return? Is it 6, or,
Yeah, 6 and
6 would be
6.5.
right, yeah.
and you want to push us up to 7.5?
That's, actually, wait, 6 to 7 on the moderate
Yeah, it's
aggressive,
all
excuse
range,
me.
yeah.
6 to 7 on the moderate aggressive where you're currently at. Because these are long-term dollars in nature, I would like to see at some point up to the 70%. Now, if you're not comfortable with that as a board, don't do it.
Well, maybe, we'll talk about it some more, but, we don't have to do it right now. We can
don't.
decide in July that we want to go that route, or, so it's not a decision, we're talking about a 30-year fund here, so the
Correct.
decision 6 months won't make a difference, but,
Not at all.
yeah.
We're just making the proposal to everybody with the unfunded liability. And I don't have the latest and the greatest, but your unfunded liability, what is the latest and greatest?
43 million.
Okay. Okay, so 43 million. And,
And another 5, yeah.
you have around $2 million.
Yeah.
We look at these as they're a 25-year-old getting ready to retire at 65, 70 years, 65 years old. You get a lot of time on your side. You can ride the markets up and down.
The pension funds, though, that, right now, we're a member of Worcester Regional, and they've been trying to scale down their expected rate of return, because they had it at 8.5%, and that was pushing the border of too high. And,
Correct.
they'd have a couple bad years, and they'd, never catch up. So they're bringing that down to 7.5, so, and you're recommending 7 to 8%?
7.5, what is it, 70, 30, 7.5 to 8%?
Yeah, I would say somewhere between 7 and 8.
7 and
just
8.
to keep it.
CalPERS, which is the largest pension plan out there, they're down to 7 to 7.5%, which they have, I think that's the biggest one out there.
And Jim, with Worcester Retirement, that's the investment type that they're in versus the discount rate that they're using?
No, Worcester Regional is using a 7.35 discount rate.
Is it 7.35?
Yeah, I don't know what I have to look at
That's
their,
pretty high.
It is,
But it's
but,
down
they're
from-
recommending 7.5
Yeah, that's the difference, though, discount rate versus,
rate of return.
versus what you're investing in, right? We're talking about different things.
Well, the pension needs to hit the discount rate to be successful. Every year they don't hit the discount rate,
You
they're
fall.
falling further behind.
they want to do
So
better
it's
than
sort of,
that. but-
yeah. Interesting question.
And we made some good changes in the last couple of years, which we're gonna look at the last 3 years. I think you'd be pleasantly surprised at the numbers. Now, obviously, this has been a great 2 years. Or, let me rephrase it. Believe it or not, actually, it's been a great last 2019. 2018 wasn't that great of a year.
Right.
We actually lost money in 2018, but 2019 was a great year.
Yeah.
So we're back on track. But if we look at a 3-year return, you've made some changes in the last 3 years that make a difference. Even some small changes such as the private equity where we're targeting, they're targeting a rate of return of 10 to 12% on the private equity. It's a small portion of your portfolio, but still, every little bit helps. So,
You may not know the answer to this question. So you use the term TWR, annualized,
yes,
time-weighted return?
Yep.
yes.
How is that different from money-weighted return? Or are they the same thing?
Money-weighted return.
Because the actuary uses money-weighted return, and they said in 2019 it was 6.25%. Your TWR is 5.7.
Yeah, so the 5.7 is since inception, so since 2012. That would be the annualized return. So that would be for all years, just annualized. But I'm not sure. I would have to check
First time I
on the
heard the money
terminology. Yeah,
weighted return from any of these
I would
actuaries.
think it's the same, but
We could find out.
Yeah, that's what KMS uses.
KMS. First time I'm hearing that, Tim, and we deal with quite a few. We deal with over 170 Opebs. I haven't heard that term yet, but I'll find out what money rated return means.
Okay,
Do you guys want to go right into the portfolio on page 3? Does that sound good?
sure.
Yep.
So on the right side of the, so on page 3 of 12, on the right side, you're gonna see 7/1/2019, the start of the fiscal year to 12/31/19. The time-weighted return, which is not an annualized number, this is only the performance for that first 6 months, some people get this confused, is at 4.58. So for the first 6 months of the year, the fiscal year, you're at a 4.58% return. The total gain after fees has been 81, call it almost 82,000 at 81,896.86. All the details are above, which includes the dividend, interest, withdrawals to pay for the fees, unrealized gains and losses, and the contribution of 420,000 year-to-date, fiscal year-to-date. On the left-hand side of the portfolio, which always shows you since inception, which you've been with us since February of 2012, the time-weighted return annualized is at a 5.70. If you go up one number, the time-weighted return for that same period for the whole portfolio has been about almost 55% at 54.73, or the total gain after all the fees has been 333,583.26. Let's go to the next page if we could, and to look at the last 3 years. I want to show you, so we've made, we started conservative, we went to moderate, then moderate aggressive. I think the last 3 years represents some of the changes that we've made. So I'm going to give it over to Kathleen on page 4 of 12. Go ahead.
yeah, so just to clarify, I don't know if we said this, but when you started in conservative, that's what we would call 50% equity, 50% fixed income, and then moderate was 60-40, and then as we said, moderate aggressive is the in-between at 5%, 65-35. So, unfortunately, we can only show the benchmarks, which are those 3 figures under your portfolio for how you're currently invested. So if you look at all the way to the right, the since inception is that 5.7 number, but you can see had this been invested in a more aggressive portfolio, it would be somewhere, north of 6. So it's not a perfect comparison to the way that you're invested now, but if you look, as Brian said, since we made that change in 2015, I believe, if you look at the more recent time periods, that's what's more applicable to measure against the benchmarks. So that first one under your portfolio is with alternatives that are not liquid. So these would be more of your typical hedge funds, which we don't use anything like that, but we'd like to include that for comparison's sake. In the third one down, the 50, 30, 20 equity bonds and liquid alternatives, that's what you have. Even private equity that we invest in would be considered that, because you do have quarterly liquidity. It's not something you have to be locked up in for 10 years. So that's the most accurate comparison. And then you have just the 65-35, which does not include any alternatives. So those are trailing time periods, quarter to date, year to date, 1 year, 3 year, 5 year, and since inception.
And bear in mind, your portfolio is net of fees. The benchmarks do not include fees. So if you want to get a more accurate number in comparison, not that you can, because depending on the deposits and the withdrawals and stuff like that. But if you added the 40 basis points for the fees, management fees, you could put that onto the 5.70, add the 0.40, and you're closer to 6.10. The benchmarks do not include the fees, okay?
So then the point.
And they also, one last
sorry.
thing, I'm sorry, just want to make sure you guys are clear on this. Because we didn't close out the account each time we bumped up the equity exposure, that's why we're dealing with, we have to use today's benchmarks with the current equity exposure versus using the ones that are applicable each step along the way. We can't do that. Does that make sense? So eventually they'll fall off and you'll have more accurate numbers that represent where your risk profile is.
So I like to focus on page 5, just as far as, I know we've talked about this before, but just our philosophy on how we try to invest these funds, because it is public money, so we are very cognizant of down markets. So we really are interested in protecting on the downside and not reaching so high on the upside of the market. So I really like to look at 2018 and 2019 as just a way to show you kind of what we're trying to achieve. So in 2018, it was a really difficult year for the markets. This portfolio was down a little over 5%, but the most applicable benchmark, if you look to the one that says liquid alternatives 2 over, that one was down over 6.5%. And then on the flip side, in 2019, this is up 16.6, and that portfolio is up almost 18%. So with alternatives and with the portfolio managers that we choose, we're really interested in downside protection, because it is public money, and we always joke, no one's knocking down the doors to see if you were up 16% and the market was up 18. That's never really maybe the issue. It's more when things are going down that people could be questioning. So we try to focus on that. I think the calendar years show that well. Yeah.
So just really for people that are listening and
Sure.
not seeing what we're seeing, you have a benchmark in here, a 65-35 equity bonds
Yes.
benchmark that this year grew 20.38%.
Yes.
Versus our portfolio, which was 16.65. But last year, it lost 6.64% versus our 5.16.
Right.
Not as dramatic. Oh, I'm sorry, the next column over was the better benchmark, that this year did 26% versus our 16, but in last year, when we were losing money, it lost twice as much as our fund lost, so
Exactly.
trying to
Yeah.
support your point a little bit.
Yes. Yeah.
And the 65-35 benchmark doesn't include alternatives. So you'll feel the highs and the lows of the markets.
More so in that kind of fund.
Correct, without the
Yes.
alternatives. The alternatives are a basket of funds that typically do better in a down market. They're not correlated to stocks and bonds, and they help smooth out the ride. That's how we say it. So you like the real crazy roller coasters, not do now, up and down with your finances? Or do you like the baby kiddie coaster, as long as we go up, right? More of a smoother ride. So the alternatives help that smooth out the ride.
And included in your alternatives are the private equity pieces. So you've had Partners Group for the longest amount of time, which
Which hasn't
I
been too
believe
low.
Yeah, I believe it was purchased in 2018, the end of 2018.
Yeah,
But this would be-
2018.
This would be included in your alternative exposure, and I like to point to, and maybe we've done it before, but if you have that Partners Group sheet, or even Pantheon, it's the same story, really. If you look at the year like 2018, on the return for Partners Group, the return on that fund for 2018 was 7.4, and then on Pantheon it was 7.6, where the public equity markets were down almost 5%. So that's what you would really want to see. You want to see something that's uncorrelated, that's up when the market is down, and that's really what these are trying to achieve, and these have. So, that's why we like to include them. Like Brian said, it can kind of make the ride a little bit easier.
If you're looking at the Partners Group, just so you're on the same page, the Partners Group, which is the one page without the staple, you're gonna look at the iShares. We have access to iShares. So if you look at that, I know that's the A and the I, you're gonna look at, we put all your funds into the iShares. They're most cost effective. Any questions on any of that so far? Please stop us along the way. A lot of information, we realize that. We deal with this every day, so.
What percentage of our funds are in alternatives now?
Yes, we can
Yes.
go over that.
Okay.
So on page 6 and 7, this lists out every single holding as of December 31st. So you purchased, what you won't see in here is Pantheon, because that was purchased at effective December 1st, and everything with those has a 1-month lag. So it's not in here yet, and we also don't have performance for that yet. So that's the only thing missing in here. Oh no, wait, I'm sorry, it is there. Oh, we had it a month prior, I'm sorry. So it is there. Apologies. So this is accurate to how it's invested. So to answer your question, alternatives, we have just under 20%.
Yep, I got it. Thank you.
So you have domestic equity, international equity, alternatives, domestic bond, and international bond. And these 2 pages give you everything when we purchase those, the description, symbol, quantity, price, value, the percent of assets, and the bold shows you how much of each of those baskets, tax cost, principal gain and loss, and then yield for every single position. So unless there are any questions on that, I'll.
And since we've come out here last year, one thing we'll point out is because we're an independent advisor, we hire and fire fund managers accordingly. We don't just do it willy-nilly, but as the markets are going up and down and we look at performance and how these various funds are doing within the sleeves that they're in, they're all on our watch list, number one, the existing holdings. Number two, we always have some holdings within the wings that we're not investing in, that we're doing due diligence on, to compare them. The internal investment management team are constantly doing their homeworks and interviewing and watching and analyzing how these funds are doing according to their targets. So as of the last time we came out, we fired under the domestic equity somebody that was in that sleeve, and we replaced them with Caroline Eagle Growth and Income Fund, who's performing much better than the last fund that was in there. And it was for several quarters in a row. Kathleen can talk a little bit about that. She was part of the team that was doing the due diligence and also did a site visit and was very instrumental in getting this fund on. But we did fire the last company and hired them. And I don't know if
Yeah, and we moved a couple of things around. We really try to invest in portfolio managers that we want to hold for the long term. That's really why everything is long-term focused. But like Brian said, if there's someone, and in that case, the portfolio manager, just the simple overview was that they were so focused on dividend yield, and that's all that they cared about investing in, and so they weren't looking at what the company was actually doing. A good example of that, if you are familiar, would be GE. Not anymore. I think they slashed their dividend, but if you were just investing in them for the dividend, you didn't look at what the company was doing, you would have missed some serious issues, really. So we'll go in there and we'll talk to them and kind of decide those things on your behalf, and everything is discretionary, obviously. So if we make a decision, we make it that day, and based on our research, yeah, the 5 of us, yep.
Just,
So that decision pretty much covers all your clients. The same, if you decide to get out of that fund manager, it's for everybody.
Yes.
You're not just looking at Sutton, you're looking at all your clients.
Correct. We
Yeah.
have several funds within, that are allowed under Chapter 203C that we have for OPEB funds that we're tracking.
Yeah.
the,
Correct.
on to the, just wanna, the private equity alternatives. I mean, the rates of return are terrific. From like even 2009, which was the heart of the recession, which was, barely negative, to generally above 10% rate of return for the last 8-9 years. What's the downside on this private equity group? I mean, it looks like a great investment, the last decade has been positive, double-digit growth, and what is the downside of private equity?
Sure, good question.
Yeah, that's a good question. Someone asked recently, I think we were together, she asked, what happens in a recession? Would this go down? Because there's still companies. And it's a really good question. So we do think public equity is clearly more, it's clearly more volatile because, first of all, they have to appease shareholders. So decisions that they're making in earnings calls, really, it's all over, I don't want to say an obsession, but there's a real focus on that. And those companies are really globalized. So if the whole world is having difficulties, that's kind of just builds upon itself for those multinational corporations and things like that. So we, obviously we can't say, and they certainly won't say, what the major downside would be.
Yeah.
But as far as the companies that are in there, these are 2 really high quality private equity. So you can have private equity where all they're trying to do is buy failing companies and try to flip them around. Those I would think would do not so well, maybe if there was some technology companies or healthcare or something like that where they're trying to flip them. These are much more high quality. We tried to focus on that to kind of protect from exactly what you're saying, because I think you would see some issues. But yeah, so I don't know if that kind of answers your question. We don't have anything of theirs to look back on in like 2007, 2008, because
Yeah.
it didn't exist.
We're very specific on the private, the firm is very specific on the private equity. Not all private equity is necessarily the same. The ones we've chosen were hand-selected after much review. This one allows quarterly liquidity, where that's not always the case. They're less liquid than that.
Okay.
These are quarterly liquidity, liquid, versus
Does
some.
that reduce our not our price, but would we get a better rate if we limited the quarterly equity and just went annually, or, I mean,
It's not
we
necessarily
don't
an
need the
option.
money, and we
Right.
don't need it for the next X period of time, so, it's nice that it's liquid, but
Yeah.
it's not needed.
It's
No.
funny, that's great.
It's a good question.
Because most people get terrified of the lack of liquidity.
Yeah, right, right, yeah.
So that's never the reaction, so I think that's great. We may eventually start recommending some of that stuff, especially for these, because like you said, you're not touching them for 30 years. But just because of the nature of treasurers and things like that, we haven't suggested that. But you are right, if you give up liquidity, the idea is that you get a higher
Yeah,
return.
more gain,
Yeah,
Okay.
yeah.
Was your basic question, why would we not want to be more exposed to those kind of things? They look like good
Well,
investments.
just the equity. I mean, we don't need the money, so we don't need a quarterly equity
Right.
available
Yeah.
to us. I mean,
Mhm.
we've been in this for 9 years, or give or take, 8 years, and
2012.
we've never taken a penny out. We just keep adding and adding and adding. So we don't need quarterly equity, 'cause we don't need the money.
Mhm.
That's what I'm saying. And I'm assuming that would be a greater rate of return if we had limited equity.
Yeah.
The fund equity though, or liquidity will affect rebalancing, correct? In other words, if we go to a less frequent, if we were invested in a fund that had less frequent availability, then if we rebalanced, we would be perhaps stuck in those positions for longer.
Yes.
Okay.
Yeah. So those we wouldn't be able to take out. We could probably add. It would probably depend on the product. Like these, you can. It's monthly subscription, quarterly liquidity, so you can get in every month. So those might be similar. You can get in more, but maybe can't get out of it as much. But yeah, you're right.
The
Yep.
19% concentration in that fund at the end of last year seems to me is above, sorry, not in that fund, that's in alternatives total, I think.
Yes.
That seems higher than our target allocation. I'm assuming that we didn't rebalance. I can't remember what our target allocation was. I thought it was around 11, but
For alternatives itself,
yes.
I believe it was 15 to 20%, but,
Is it okay?
Should be. Yeah.
let me,
I think
Chairman,
it sounds familiar.
Voted on that, yeah.
yeah, as an alternatives, in the alternative sleeve, in general, that strips out the right now you're currently, according to this, 4.81% in private equity.
Okay, I
The
guess where I'm
target-
going with the question was, did we rebalance at the end of the year, or do we have a rebalance coming up? But just based on what I thought was an overweighting in that.
Yeah. Yeah, so I don't know off the top of my head. I know that when you deposited money, which looks like it was recent,
Yeah.
Oh, yes.
that's when we would have
Probably after the fall
rebalanced
town
then.
meeting.
Yeah, we would have rebalanced then, so it should be pretty in line at this point. So 20% is what we're targeting, especially if you have private equity. When we didn't have private equity, we targeted 15%,
Okay.
just because it's a slim pickings in the alternative space, but once we added that in, it's been 20. So if it's reflected in the IPS, we can check. I
We can
don't know.
check.
Yeah.
You don't have a copy of the current I usually have it with me, and I apologize, I don't. But offhand, the alternatives are 15 to 20%. Private equity is 0 to 10%.
Mm-hmm.
Okay, maybe I'm thinking about the private equity portion
Yeah.
specifically.
Yeah, and it's depending on the so the high of the private equity in itself is 10%. It's currently at a little under 5,
Okay.
or as of 12/31. And we would recommend in the moderate, you're currently a little under 5%, 4.81. In the moderate aggressive risk profile, you could bring that up to 6.5 comfortably, which would be fine. Now, bear in mind, this is a snapshot in time on 12/31, so we could have some things going on.
Okay.
But if the November, we made a deposit, I have on my notes, November 12th-ish, I don't have the exact date, but November 12th, 19, you added another 300, a couple days prior to that, you added another 300,000 for the deposit from the town meeting. Does that sound right, Mr. Chairman, or roughly?
Yep.
So we would have rebalanced it then, and at a minimum, we try to rebalance when there's additional funds, or
At least annually.
at least annually.
Yeah.
Okay.
Did that answer your question?
It did, yeah.
Any other concerns on out of
No,
target?
again, I was remembering the 10 or 11,
Yeah.
Yeah.
from the last meeting, but I was incorrectly applying it here, so
Mhm.
Yeah.
that just answered it, thank you.
Is everybody comfortable with that?
Yeah.
Okay.
Just one quick question.
Yes, sir?
Without alternatives, a moderate or aggressive portfolio would be a 65-35 balance, is that what you said?
Yes.
Yes.
So if you add alternatives, where do you take the 20% from? Is it from the equity?
It's from both.
It's from
Yeah. Yep. So, in this case, you have, yeah. So,
Page,
well,
Yeah, okay, go
15% of it is taken from equity,
Okay.
and the other 5 is taken from fixed income. Yep.
and it says it on page 3 with the benchmarks there. Is it page 3? Let's see. Just go to page 3 for me.
4?
4, excuse me.
Yeah.
It says, but it won't have that breakdown.
Yeah, it doesn't
You're
have
right.
the
Okay.
breakdown, yeah.
So 50% in this case, it's 50% equity, 30% bonds, and then 20% alternatives, but that 20% alternatives isn't broken up. So in this case, in your case, it's 15.5.
Okay.
15.5. Any other questions on that portion so far?
Sorry, can we just go back and ask a quick question about the asset allocation? Sorry, not the asset allocation, the dollar cost averaging. Is that an account, how does that work with you? Is that an account that you maintain and then dollar cost average in, or is that something that towns are responsible for doing on their own? And
Sure, good question. So the town would be responsible to make their contribution, well, two things, actually. Under your trust fund, since you have a trust fund with us, you could put it in a trust fund line item in your trust fund account, and we could manage that for you. We could put, i.e., $100,000 into the trust fund account, call it Opeb, Opeb funding account, if you will. And then we could create a schedule ahead of time and manage that for you and put $25,000 each quarter in, what was ever predetermined in this scenario. Or the treasurer could make those contributions quarterly. So either way, we're flexible. Because you have two accounts with us as the town, we could manage it either way.
thank you.
All right, any other questions? You have more to present, or?
Do you have anything else you want to talk about on the,
No, that's.
did you want to go
that's the high
through the,
points. Yeah, so the only
Last
thing
part?
I guess I'll say, so page 8 has a lot of risk metrics, but then if you look at page 9 and page 10, it really encapsulates all of those, and kind of what I was saying about taking, we really try to achieve taking less risk, but still maintaining, a similar return to the benchmark. So if you look at page 9, this is over a 3-year time period. Your portfolio is the A and the B. Oh, I should also say, on the left-hand side, that's return, and on the bottom is standard deviation, which is really just the risk in the portfolio. So you can see your portfolio, the A and the B, is taking on less risk, but with similar return to the benchmarks over a 3-year period, and then on page 10, you have over a 5-year period. So really what we want is to take less risk, like I said, still keep up with the markets over the long term. And that's just, I like visuals, so I like those two graphs, because I think it visually tries to explain that.
Makes sense.
any questions on any of that?
Can I just go back to page 6 and 7?
Sure.
So the second to the right-hand most column is gain or loss?
Yes.
What is the time period on that? Oh, prior month end? Well, I don't know. That can't be month.
No, so that's since inception.
Since inception, okay.
Yes. Yep.
So I can't tie that into any page over here.
You can tie it into, the only part you can tie it into is on page 3. All of the unrealized gains and losses on the left-hand side.
If I add
If
them
you
all
see
up,
that,
okay.
yeah.
Okay,
Yep.
got it.
Mm-hmm.
I don't know if this adds value, Mr. Chairman, but, just going around, we do deal with close to 170 OPEB community, 170 OPEB accounts, or close to, and we deal with several different communities. Some of the, I don't know if you already incorporated this in your funding policy for OPEB, but some of the best practices are out there that will help your unfunded liability today, is to implement on your funding policy, not that you have to do this, but these are some of the ideas floating around. Hopefully this adds a little bit of value without creating conflict. But what communities are doing is they're putting in their investment funding policy for OPEB. Once their pension liabilities are fully funded in 2035, that you will take all or some of that and apply it to the OPEB obligation. I don't know if you're already doing that.
Yep.
Great. That's
We
best
also
practice.
have a 10% of our free cash, certified free cash going towards OPEB, which
Excellent.
this year was close to $3 million, so 300,000 went into the OPEB account, so.
Excellent, excellent.
But again, that's not our own creation, it's following the news as well. And
Well, we're just trying to share it because not everybody hears about it. So we are trying to share it, and we're glad you guys are doing that. That will help.
We're not so sure about the 2035 date, though.
Well, I understand.
Well, my expectation, though, is that this year's rate of return for the pension has to be healthy. So I'm hoping that solidifies the 2035. If it was minus 20%, then it would weaken it, but hopefully I will find out Thursday, I guess, at the meeting.
So I'm glad you guys are doing that. If there's anything else that you think we could add value next time, please let us know. Any way you'd like us to change the format of this, please let us know as well.
Okay. Thought it was very helpful.
Yeah.
That's good
Thank you.
information.
Thank you.
We appreciate it.
So just on, the recommendation that we go into aggressive portfolio. So that brings the current expectation of rate of return from 7 or 6, 7,
6 to 7.
6 to 7 to
So
7
moving
to 8.
flow with this low interest rate
I
environment.
hear you. Listen,
Yeah.
trust me.
You know, it used to be 10 to
You don't wanna be in
12%.
bonds right now.
No.
But,
20 years ago.
yeah, so aggressive is what, 7 to 8 range, or give me an idea?
Yeah.
So remember, when we're talking about this, everybody has a different, many people have different definitions of conservative to aggressive.
I wanna know Bartholomew's.
So ours is 70-30 aggressive.
And that
7 to 8.
expected rate of return
Yes.
is what on average?
Call it 7 to 8%.
What does that translate to with the alternatives for holdings?
Oh, sure. So, good
It's
question.
inclusive, yep.
What's that?
That's inclusive, yep.
That's inclusive. Oh, you're wanting to know the split, the breakdown?
Right, because before what we said was the
Oh.
alternatives kind of pulled from one
Correct.
side or the other.
So you'd go well, in this case, it would be 65%.
So,
Well, no, it would be 70% still, but
Yep.
we're gonna pull 15% of that equity out of alternatives. Does that make sense? So you're just gonna increase the current equity exposure.
right, the alternatives
5%.
will stay 20%.
Yeah.
Okay.
Yeah.
We're not gonna go any higher on the alternative.
So if we invest in another one of these private equity, then you just liquidate some of the alternatives?
Yeah. Yep.
And increasing the private equity doesn't necessarily change your risk exposure, necessarily. Correct?
Right.
We have room to grow in that, because you're at a 5%, and as you do ratchet up the portfolio from moderate, aggressive to aggressive, our recommendation for private equity goes up slightly for the percentage of the portfolio. It goes up from a moderate aggressive portfolio, we recommend 6.5%, depending on the value, at a 1,540,000, with the account value at 1,540,000. And in a aggressive portfolio, we recommend 7%.
But if we stayed where we are right now,
Stayed where you are right now,
we have.
Which is
room to-
okay.
We have room to put more in the private
Yeah.
equity, because we're at 2 million.
you could. And I'm gonna check back when we get back to the office to see, what the standings are today. But you could, right now you're at 5, you could go up another 2.5%.
Which would be, what, another 50,000? Is that right?
Yep.
Yep.
So we could go up another 2.5%. Does that make sense? I wondered, Tim, if we, when we added the private equity, if we were considering that $300,000 deposit there at the time. I don't know what the timing was on that. I have to look back at the notes.
It's awful close.
It is, but I don't know if that came in after. I'm thinking it came in after. That's why it's down-weighted. Do you know what I mean?
Yeah, because I'm not sure the date that we actually sent that 315,000 over. It would have been after the
After the-
October town meeting,
right.
so it would have been right around the beginning of November.
So I'd have to look at the time frame and see.
Yeah.
But we can get new paperwork together for Lisa to sign, to get it up if you want. That's,
Well, it's up to the board.
regardless of changing equity exposure, the private equity recommendation for your current risk profile is to go up to 6.5%. Right now, you're at 5. I assume it has something to do with the timing of that extra 300,000. The reason why private equity, we have to rebalance with additional paperwork. That's why we can't do it internally. We have to get it's the one thing, private equity is the one thing in our accounts that we can't just rebalance ourselves. We need to get the treasurer involved with some additional paperwork. So we typically do that once a year or when there's a larger deposit. And it looks like you guys have been pretty aggressive on your deposits, so. I can look at that and get back to you.
Okay.
I'll let Lisa know. We just fall within the target range of that 0 to 10% anyway, so I don't know if there's board approval needed. That's up to you guys though, so. I don't think there is.
No, I think we already voted originally.
Right, and it's within your targets
It's
anyway.
in the targets,
So-
absolutely. I'm certain of that.
And I don't know, what does everybody think about the idea of moving to the aggressive, alternative? I mean, what I'm hearing, well, I don't wanna speak for other people, but conservatively,
Yeah, right now, I would recommend, I'm not a voting member of this board, but I would recommend delaying that decision until, 6 months to, a year is not gonna make a bit of difference in this whole thing, but the only concern is the market right now is frothy, if you will. And it went up 30%, and if it's not, I don't see it going up another 30%. So and there's a lot of potential volatility. Right now, our 3-year rate of return is 7.37. It's not bad. That's sort of,
right, it's
aggressive
within the range anyway.
right now. But a lot of that's based upon the market. That's just my thoughts.
I agree with you.
Yeah, actually, that's exactly how I feel. I can't see us backing up a year like we just had with another great year. Any thoughts?
Yeah, I think that's right. I think we're at the height of a market or close to the height of a market in a very volatile, a year that gives us a lot of opportunity for volatility. So I think prudence suggests waiting a little bit.
All right,
Sounds good.
Okay,
all right,
Excellent.
thank you.
thank you.
Thank
We
you.
appreciate it.
Yeah, thanks for
And
coming
bear in
out
mind, you
again.
can do that anytime and,
Yeah.
if you could specifically do it on December 24th of 2018, that would be great.
Yeah.
Backdate everything.
Go back to the future for that one.
Yeah.
Where is that? Well, thank you. We
Thank you.
appreciate it.
Yeah, thank you.
Thanks, John.
All right, so under new and old business, I just handed out a whole bunch of paperwork. 2 of them are just so you know that the accounting internally is matching what Bartholomew has. So I've given you the spreadsheet on Opeb contributions through June 30, 19, which shows all the contributions and the, if I could spell, cumulative earnings, missing an A in there. So at June 30, we had a portfolio of $1,492,000, and as of December 31st, with that $315,000 additional contribution plus the increase in the market, we're just under $2 million in our portfolio, which, like I said, agrees to what Bartholomew has, so that's good. This one I didn't hand out, I'm gonna hand it out right now. So, this one, so in the past, for both the town report, for internal reporting, when I give the auditors, what the auditors report in the financial statement, has been an operating statement that pretty much just shows town appropriation at the top and investment income, fund balance, beginning of year, end of year. I was at a conference back in October, and listening to the speakers, it became apparent that these statements really, to be really full disclosure really should be showing the employer and the employee contributions as if we actually took the money, put it into the trust, and then paid the retiree premiums out of the trust. So you'll see that the employer and employee contributions, that adds up to, the revenue side is $739,000, the expense is $739. Doesn't change the bottom line, but I think it gives a much better picture of really what's going on with the trust. If we were doing it, if we were making the contributions for all the withholdings, for the premiums, and then paying the premiums out of the trust.
Yeah, I like that.
Otherwise, we're looking at its trust saying, all we're doing is giving it money and it's just sitting there and it's growing, but we're not doing anything with it. Well, sort of we are doing something with it. We're not actually we're not exchanging checks every month. But there is money, in a big picture, there is money going in and money coming out. And this gives you a chance to look at how the retiree health insurance premiums have grown from one year to the next. It's grown $100,000, and that's probably gonna be pretty similar as our
That's a-
population continues to age out, retire. Every year, you can count on a few more retirees.
So is that more attributable to the number of people being covered or the rise in premiums?
The majority of the retirees are 65 and older, so they're on Medicare. That's a fairly inexpensive policy compared to a typical family plan for an active employee.
Yeah.
So that increases primarily, I'd say, the number of retirees.
No kidding.
That looks like, not quite 15%, but a big number. I mean, that's a significant increase year over year.
Yep.
But if that continues, it goes up, another 100,000. I mean, it's,
Well, it'd be interesting to watch this trend.
Yeah.
I didn't do 2017, I could. Or we just wait another 6
Yeah,
months and I'll have
let's just do that.
2020 in
Yeah.
there, and we can see how this is trending. And I have to, now that I've got the OPEB valuation, I'll complete the bottom of it, which I didn't have time to, which is what the net OPEB liability is and the number of retirees. I actually have the information from KMS, so our number of, total plan members went from 394 to 423, from June 30, 18 to June 30, 19. Our covered payroll went up $600,000 in 1 year.
our, I guess, cost of living adjustments don't go up 600,000 a year.
Well, that covered payroll is a 3.7% increase, so it's pretty close to what's going on.
Yeah, but what gets me is the OPEB liability went up almost $5 million in 1 year.
Right.
That,
Well, it's two factors. One is the number of plan members went up 27.
I think I know the answer to this, but do you recall, is that because there were some people that opted out of our health insurance plan and they brought them on because they can retire on our plan and get health insurance from us, so they started counting them?
Well, we got, the big hit was from 17 to 18. When we switched to KMS, they picked up all the inactive members that could come back
Okay.
and treat them as a potential liability.
Did they treat them at full value, or was there some actuarial calculation
I'm sure
around
they
how many
take
of them?
some kind of percentage and say, yeah, there's a percentage that may not come back.
Yeah,
And then the other thing is the discount rate. They do their calculation based on GASB rules. went from 3.88 down to 3.54. So as the discount rate goes down, our liability goes up. So that's accounting for a big piece of the increase in the net
So-
OPEB liability.
As I recall, we took that on kind of purposefully because we felt like KMS, their techniques we liked better. You know, it's more conservative, gives you maybe a bigger number, a more frightening number to deal with, but.
More accurate.
But we
Worst
just
case
liked,
scenario.
yeah, we just liked the results better, you know?
Yep.
Yeah, liked is it,
Yeah, right, in quotes.
but it wasn't, we didn't choose them, without taking this into account. We felt like they were a better alternative as a provider, right?
Right, true, very true.
Tim, you said the covered employees went from 394 to
23.
423. That was just in 1 year?
Yep. I mean, it's always possible that some individuals got missed in 18, that got picked up in 19. There's
That would be
always-
interesting to hear from, I don't know whether it's Linda or whoever did that presentation a year ago, that why that dramatic increase when we brought the opt-outs on board from 17 to 18.
And it's more than just the opt-outs. I mean, we have employees who were never on our plan because they were covered on their spouse, that were brought on in 18.
Okay.
You know, active members went from 300 to 312. You know, it could be, some of that could be a situation where you have, maybe you have an employee that is covered by our health insurance, their spouse has their own plan with their company. And now, maybe that spouse turned 65 and has come onto our plan or something. You know, there's all sorts of scenarios that could affect that. So I don't think we had that many people, if any, that actually came on board. But then you also have turnover. You have, the biggest turnover we have is the school department. You could have a handful of employees who left that weren't covered by our insurance, and then they got replaced by ones who did. Or they went from, for the liability, it may have been an individual plan replaced with a family plan. So there's all sorts of factors that will affect this. This was just an interim date. They do a full valuation next year.
What was the OPEB liability?
The net was 42,918,819, so 43 million, up from 38 million.
Roughly a $5 million increase over 12 months. Yeah, this is sobering, and, my concern eventually, if the state ever wakes up and becomes aware that they've got an OPEB issue at the state level, that this could become mandatory, that every community develop an OPEB funding policy with rules and regulations. I mean, I've seen this take place back with pensions back in the late 80s and early 90s when they were starting out, and then they were figuring it out and, put the original 2018 as the original funding schedule. But that's my one concern, is this will become mandatory at some point. And, they started in 2007 talking about this, and at that point it was like, do whatever you can, don't worry about it. The rating agencies don't pay attention to it. Now, our recent ratings visit with S&P, they were all about OPEB, how much you have funded, what's your strategy, how are you gonna address it. It's like, wow, that went a long way within a 10-year period of time. So that is my one concern, is, it's a liability that could be a mandate at some point in time.
So then I handed out a bunch of other information I get from Odyssey advisors. I think Parker Elmore, I think, is a pretty well-respected name. I think he may be involved with Pritt. doing their evaluation. But anyway, I mean, one of them, just some highlights in this one email. The percentage of municipalities funding their OPEB liability increased from 79% to 88% over the year. So again, it shows the trend, and more people are getting on board and realizing they need to start funding their OPEB liability. In the meantime, the 20-year municipal bond index declined from 3.64 to 3.26, which is reflected, our discount rate also declined, and that pushes the liabilities up higher. You know, it just shows that, yeah, I mean, that net OPEB liability is not cast in stone. It's a reflection of assumptions. It'll fluctuate from year to year based on various changes in the assumptions.
And what did you say our discount rate that we're using is?
Ours is 3.54.
And according to this email that you just gave us, the median discount rate used for OPEB valuations remain constant at 4.25%. So we're being more conservative than typical.
It's the calculation, so, I mean, I'd have to get a better understanding from KNS on how they come up with that. But I think a lot of it has to do with funding, the guaranteed funding. All we have guaranteed funding is the 105 a year that's in our budget, and then the cell tower, we have a lease.
Yep.
And the lease is fixed in time, so they only give us credit for that time period, was it 10 years or something? After that, that drops off to zero again. So they take that into account, the assets that we're putting in, and at some point, there's a graph that they do, and it shows, I don't even know if it's in this report.
But sort of simply put, if we just switch from 3.54 to 4.25, our liability would actually reflect lower than it does, right? So I guess that's all I mean by being conservative relative to the average.
Yeah, so there's a calculation of a single discount rate in this report, and I can get you a copy of it at the
Yeah,
end
I'm
of the
gonna
meeting.
look at that.
But it shows that based on our current funding, in the year 2027, if I know how to read this thing, our projected ending fiduciary net position is zero. Right now, we have assets as of June 30 of 1,492,000. I guess there's, you know, they're looking at the benefits that we have to pay out and what we're putting in. We'd run out of, if we were actually using it right now, we'd run out of assets in 2027, and at that point, we're back to zero again. So that has an effect on the calculating the discount rate.
Okay.
Not that I really understand it that much, but there's a whole thing in here on how they calculate the single discount rate.
Yeah.
If you
Some
want some
nighttime reading.
nighttime reading. Let's see. Yeah, it's interesting, even in Odyssey's trend report, they even say they've got a trend that they're seeing post-pension funding. So they mention it in their report too, which is what we're doing, and part of me thinks that part of what Brian has seen is the number of funding policies, town of Sutton funding policies that I've handed out to clients in the past year. So a lot of them may have been adopting the language that we adopted first, or early, or one of the few in the beginning.
And to your point, Jim, I think the discussions we've been having is that policy reflects the idea that the Commonwealth may very well dovetail the end of the funding for the pension plan with the beginning of mandatory funding for.
Yeah.
It would make
OPEB.
sense.
Yeah.
And you know, what they just need is a governor to take up the issue, you know, and to kind of, you know, create a policy that doesn't really affect anybody today, but 10, 15 years from now, it'll.
Yep.
You know, if people are expecting a big,
Windfall.
yeah, in the future, then, you know, if they've got an OPEB liability, I don't think that's coming.
Yep, that makes sense.
Is anybody interested in getting the full report? I can have Lisa email them to you if you'd
Yeah,
like to.
that would be
Sure.
great if you could do that.
Great.
And so that's new, just recently
It
updated?
just came out
Last week?
a week ago, yeah. So I really haven't
Yeah,
dove into it yet.
you have nothing to do this time of year, right?
Yeah, that's right.
It's sobering.
Yeah, there's a lot of information in here. Well, I have nothing else. If anybody else has anything they'd like to discuss under new and old business?
Just a question, so we don't lose sight of it. And I don't know if it's necessarily a board decision about whether or not we utilize dollar cost averaging for the investments, but that was another question I asked today, that we have to keep on the radar if it is.
I guess, I haven't really thought about it. I think I will be more aware of, I don't know if I wanna have to worry about, gee, we're making $100,000 contribution, I gotta remember each quarter to remind Lisa or put in a voucher to pay the 25,000 over to get to our 100. At a minimum, I think I'm gonna be a little more aware of what the market's doing, so if we're all of a sudden on a trend of it's very high, maybe I don't wanna maybe I'll just wait another week and just see what happens, or, see if I can try and time it a little bit while it's down before it starts going back up again, instead of hitting it at the peak, and we have no place to go but down. I just thought of that as I handed my setback contribution. I'm like, oh, maybe I shouldn't have done it today.
Yeah. So that was the reason I asked the question of them as to whether or not they will administer that, because it can be an administrative burden to deal with that on an ongoing basis, so it sounded like they can, although it may still have some administrative impact on our side, but
Yeah, I'd be interested in if there's any kind of data out there on, if we have, what do we invest, 315,000 this fall, if there's any data on investing the 300 today versus waiting to implement that 300,000 over a 10-month or a 12-month period of time. I don't know whether you get a dollar cost benefit of you've got the 300,000, but you're gonna wait to invest it. So it's sitting in a cash account, which is getting 0.1% interest and not making any money off it. So it's hard to know whether it makes sense to invest it all or wait with that 300 and only put a little bit in and then a little bit more over a period of time. I don't know what.
The funny thing is, I think we've had this conversation, not this particular one, but about market timing in years past with Bartholomew, and they've said they don't encourage market timing.
Right.
And now he's suggesting we look at that. So it's
Yeah.
interesting, they've changed their view.
I don't know that they would consider that market timing necessarily, and I don't want to speak on behalf of them, but the concept of dollar cost averaging is that you're taking a single investment you might put into the market on one particular day, and you're spreading it out over a schedule of time, so you're not necessarily picking the times in the future, you're just deciding you're gonna break it into smaller bites and minimize the chances that you will go into the market on the high, on the most expensive day, is really the concept. You're trying to spread that out a little bit, but you're right, every day that money is in a cash account that's not in the market,
Right. Yeah.
so, that's the effect there, and then also your returns will ultimately be impacted by, if it's something that's administered by Bartholomew, and if there's a fee associated with that, that has to factor into the mix as well as any, if they do it versus us, if there's a difference in the cash account return, if I can call it that, that plays into the ultimate return
And
anyway, so.
what are they gonna do with the money? Are they gonna put it into a savings account? Cause if they invested in a fund that's gonna be, even if it was 50-50, we still have the chance of losing some of that money we just gave them, why we make periodic withdrawals out of that to invest.
I mean,
So,
eventually, you know, when we put, if we have another year where we get significant free cash, I don't see it, but if we have another year of 300,000, you know, now our account is over $2 million. You know, as it gets more and more, it's up at 5 million. 300 isn't gonna impact that all that much. So I like the way we're doing it now. As soon as we get the money, we put it in. You know, we put it in twice. We put it in after the Maytown meeting in July, and then generally November. So that's sort of market, dollar cost averaging, but not entirely. It's just, I don't know.
Yeah, I was asking the question only just to make sure we considered it, you know, I
Yeah.
can understand that there's gonna be some administrative burden as well as some other concerns that go along with it. You know, I'm comfortable with the conclusions here if it feels like it's gonna be, it would be nice if there was a way that we could somehow scope out what that might look like, but I think it's a real difficult thing to actually, you're relying on assumptions about, you know, about the laws of the markets generally, that going all in on one day, you
Yeah.
know, if you pick the wrong day, what does that do? Your valuation over time, over 30 years,
Yeah,
you know, you can make an assumption that doing it in small pieces is better, but, you know, all these other things factored in, I don't know how to come up with a reasonable measurement without wasting a lot of time in it, so if we're comfortable with the way it's at, I think that's fine. Just wanted to make sure we had the conversation on it since
Yeah.
they asked.
well, I'll definitely keep that in mind if we have a situation like we did this fall, next fall, just to keep that in mind, or maybe take the 300 and break it into a couple pieces. I don't think the 100,000 that we put in July 1st is gonna make any difference if we do it 100 right away, or a couple pieces of 50. It's small dollars.
And you're kind of bound by fiscal years, right? So you have to basically have it all done for this year by the end of the fiscal year? Could you carry it over and, you know, so how much time did you have between when the town meeting that authorized it came up and the end of the fiscal year?
Well, town meeting was the end of October, so I still had,
6-8 months?
right.
Yeah.
yeah, I'm good.
All right, if there's nothing else, take a motion to adjourn.
Can we schedule the next meeting, get an idea? I mean, we don't wanna go a
I wanna-
whole,
Yeah, I don't wanna go a whole year. I think we
Year.
waited because we had this valuation was late,
okay,
turnover and
okay.
positions and,
So July generally, give or take, June,
yeah,
July?
well, vacations, probably August,
Okay.
be good.
I'll second the motion to adjourn.
Second?
All in favor?
Aye.
Great, thank you.